This is Carl A. Smith, aka Dr. Cash, coming to you today with a little chart school. We have received a number of questions on how to read charts, what are charts, and what can we use charts for to help enhance our investment strategy. So today we're going to kind of walk through some very basics on what is a chart. So what you have in front of you today is a chart of the S&P 500 ETF. And we'll walk through a number of the attributes that you see in front of you, but the primary vehicle that we use at Carl A. Smith Holdings is the S&P 500. So what is a chart? Let's just start off to try to orientate you to the axis and what you see right in front of you. As with any chart that you may have seen in school, albeit high school, college, or in your work today, you always want to look at the axis. What is it actually showing you? So this is a chart, again, of the S&P 500 over a 1-year period. So the tools that we use show the period in the upper left-hand corner. So you always want to orientate you over, well, how much time is this data being represented in front of me? Additionally, you want to take a look at well, what is the axis that we're looking at? So over here, you have your price. And here at the bottom, you have the overall representation of time. So before you look at any type of chart, albeit at work, albeit in your personal life, you always want to orientate yourself to what is the chart actually trying to show me. So in this example, we're showing you the price movement of the S&P 500 over a 1-year period of time. And each one of those periods is representative by 1 week of time. And that's important because you can also manipulate data to show you whatever you want to show you. We all know that have spent any time in the corporate environment. But each one of these, what we call candlesticks, is representative of 1 week's of price action. And these candlesticks, and we have another video that will really detail you exactly what is a candlestick and how to read a candlestick in the proper fashion. It just shows you the graphical representation of the price movement of that particular security that you're evaluating over a period of time. So this price movement is called the auction process. So what is an auction? It's just like what you see maybe on A&E or some other reality TV show that has a buyer and a seller coming together and haggling over a particular price. The buyer wants to buy a good at the least amount of price, and the seller wants to sell their good at the maximum price. So the auction process drives the movement of that price. Now, why is that important when you have a particular chart? It shows you the price movement of that security and that auction over a period of time, where you have buyers and sellers, again, coming together and haggling over that particular good and service. In this case, it's the S&P 500. However, it could be anything. It could be orange juice. It could be a house. It could be Facebook. It could be Amazon. So any type of haggling back and forth, you're actually producing some type of auction. So in this example, we showcase higher price movement depicted in a green candlestick. And we'll show you that here, pretty much all through here. That was a great period of time for a bullish run. As well as we have red candlesticks that show you negative price movement. And that shows that the sellers are actually in control of that auction process. Here. As you can tell, just looking at this chart, there's relatively few bearish candles because we've been in a tremendous bullish run, meaning that price movement has been continuing to go up month over month and week over week. Is this maintainable? Of course it has. It's been going on for the last 10 years or so. Eventually, the sellers will step in to take over control. However, in this period of time, what you see in front of you is the bulls or the buyers have been in total control. Now, the auction process can be controlled by different players. Short-term traders like day traders, medium-term investors, and large-term players, typically your larger banks or your big institutions like Vanguard or BlackRock, Bank of America, Wells Fargo, etc. typically will look at charts in a different fashion. They don't necessarily view what takes place on a daily basis. They typically will make decisions on a weekly basis, or even better, a monthly or yearly basis. The larger institutions, typical investors such as yourself, potentially, you may make decisions on a shorter period of time. So also when you're looking at a chart, it's increasingly important for you to look at the period of time, because as you know, depending on the period of time you're showing information, you can manipulate that information to form a specific hypothesis. So here at Carly Smith Holdings, we typically will start off with a weekly chart and then be able to make decisions on a monthly. We'll review that in just a second. We'll change the period so you can see exactly what we're talking about. Actually, let's just go ahead and do that. So we just quickly changed the period of time to a 3-year monthly chart. So again, each one of the candlesticks that's showing in front of you is 1 month's worth of price action, which becomes important as you determine who's in control of the auction. As you can see, the trend or the direction of price movement is still the same as the previous chart. However, the period of time is extended. So as you know, as you step back from certain pieces of information, you tend to see certain things that you wouldn't necessarily see if you were looking on a smaller time frame. So we're going to take the same chart and change it to a 1-year daily chart. Obviously it becomes very, very busy because there's multiple auctions every day versus what we saw previously on a monthly and on a weekly chart. So you always want to begin to come up with a story based upon the viewpoint to understand who's in control of the auction. And we have another video that really dives in deeply into that particular area. So what we'll do is we'll now go back to the previous chart to where we started, which was a 1-year weekly chart. And one of the other key things that we receive questions on is, Carl, when is it a good time to buy or sell a particular stock? Well, that's the magic question, or the billion-dollar, trillion-dollar question. If everyone knew exactly where you wanted to buy or sell a particular stock, we'd all be rich. There is no exact formula to determine that. However, you, just like a scavenger hunt, you're looking for certain clues to help you find the ultimate goal. And the ultimate goal is to become profitable or to increase your investment. Now, there's a few ways to do that, and we're going to walk through just a few of those today. Now, for anyone that has viewing this video that's a little bit more advanced, you know there is literally over 1 million+ indicators that are out there to help answer that particular question on when is it a good time to buy or sell a stock. So I'm just going to walk through just a couple that we use. And the first one is what we call moving averages, right? So moving averages are these colorful squiggly lines that are going across your screen. And some of the moving averages that we follow are the 9 period, the 20 period, the 50 period, the 100 period, and the 200 period. So we look at this large spread because, again, as we stated earlier, we're looking to try to determine who's in control of the auction. And certain instances where a short-term trader may look at a 9 period or a 20 period moving average versus Wells Fargo or Bank of America are only going to really look at maybe a 200 period average or a 100 period average because they're looking at it from a longer term lens versus a shorter term player. So one of the things that we try to do is look at a broad spread to highlight exactly who's in control, and if there is a particular movement or a movement change or directional change that's relatively close to a moving average, that can give you a certain indication of who's in control. A good example is here back in November of last year, where you see exactly here where at this point you have seen selling take place right at the 9 period average. And that's important because now we can determine that shorter term traders are in control of the auction. And you can kind of see this price movement following this average to some degree and then turning around and beginning to move forward. You definitely saw this here toward the latter part of 2018. You saw that the price moved down below the 20 period moving average, at least on the weekly chart, and big institutions saw that as a buying opportunity, and you've seen what's happened. And that's important as we look to evaluate to try to to some degree, time our entry and time our exits. Moving averages are a key indicator that we use to kind of help us identify those areas. It's basically leaving us clues, right? Now, as we stated earlier, moving averages are only accurate to the period to which they're looking at. And we'll give you a quick example of that. So as we've denoted back here in December, this was a cross below the 200 period moving average on the weekly chart. Now, if we change that lens to expand it out, that 200 period average shows a little bit differently. And that could also not necessarily line up with the monthly chart, where it actually is the 50 period moving average on the monthly, which is equated to the 200 period moving average. So how do we use this, right? So this becomes important depending upon your lens. So most individuals that are looking to invest money over the long term, you typically would make your decisions on the monthly or even the yearly. And shorter term traders or medium term traders will look at the weekly, and shorter term traders will look at day, if not intraday, and those period moving averages will line up very, very differently. As an example, the 200 weekly moving average lines up to the 50-month moving average, as you can see here. And if we change that to the daily, none of those line up exactly to where they were, right? So this becomes important as you're doing your analysis. Additionally, a way to determine when to buy and sell is associated to what we call support and resistance. Now, we will have a very detailed video that goes through the details of what support and resistance is, and we'll just give you a high-level overview of what that is. So when you think of resistance, think of a ceiling in your house, in your office, your garage, your car, where there is some type of barrier to go upward. That is what we consider resistance. So we've drawn this yellow horizontal line to kind of indicate that. Additionally, support is an area where it consider that your floor, same house, same car, same office, where you can't go down to the basement or go down to the lower floor to where you are. And that's where we see that relatively consistently on a few different examples here where price has not been able to move below a certain level. So always remember that price is just an advertising mechanism to engage buyers and sellers to step in. However, when you look at a chart, there's typically visual references to help identify certain clues to where buyers and sellers may make a different decision. So most recently, over the last few weeks, we saw that this horizontal line or resistance has become very, very important. And that's something that can lead us clues to an opportunity if price moves back above that level. As we saw, it was relatively rejected over the last few weeks, that became a very important clue that this level is very, very important. And if price moves through that, it most likely will have a higher probability of continuing forward. And that's exactly what it did. Alternatively, when you have some type of support, that typically will showcase an opportunity for you to potentially step out of a particular trade, as price on the average, if it breaks through some type of support, it's going to continue to move forward with a little bit of aggressiveness. And we did see that toward the latter part of the year. So both support and resistance, as well as moving averages, are a key component that we look at for determining value or determining opportunities for us to either sell a particular trade or step into and create a new particular trade. So there's a few areas that we look at that really help us make that type of determination. So as with anything, price is important, but remember, it's just an advertising mechanism. Volume becomes very, very important. What is volume? Volume is where you have a buyer and seller coming together and agreeing on price, and that good and service is exchanged. And that's important to determine conviction. Do people feel that this particular price is appropriate? You think about it. Well, buyers, they want to do what? They want to buy as low as possible and sell as high as possible. And sellers just want to do the converse of that. They want to sell at the maximum price and potentially rebuy it again at a lower price. You think about it from a home sales perspective. You as a homeowner, you're trying to sell your house for as much as possible. So say $500,000, right? Or $1 million, depending on where you live. And the buyer wants to buy that house for as least amount of possible. Now, what does your realtor do when you're looking to sell or to buy? They do what they call comps. They look at comparative sales across the neighborhood or across this particular zip code to give you a spread of prices. And that becomes important to determine how to price your own particular house. And those homes that are priced appropriately, typically it's a quicker transaction, which creates volume. And the more volume that takes place over a certain period of time helps indicate a particular trend. And that becomes important as you're trying to determine, well, if I buy at this price, is there a higher probability that I can sell it at a higher price? And that's where the trend becomes important. So clearly over the last 10 years almost, if not a little bit longer, we've been in a bullish trend, meaning that if you bought at almost any price, if you held it long enough, you would make money over a particular time frame. So again, we've shown you a 1-week chart of the S&P 500, and you clearly can see that there has been a strong bullish trend over the last number of years. And we have seen most recently a breakthrough of the resistance line that has kind of held strong roughly a little bit over a year. And that becomes important because there are buyers that have stepped in at this level feeling that price will continue to go upward, and that's a high probability of doing that. Now, is that guaranteed? Absolutely not. So we say all of this is to help you begin to put together the breadcrumbs to make a good informed decision on direction. Now, there's been studies that showcase that the stock market goes up 98% of the time, but that 2% when it doesn't goes down very, very violently. And we've seen that in 2008, and we've seen that relatively aggressively over the Q4 of 2018. And that becomes important to keep that in mind. So there's always risk that's associated with anything. However, the chart will leave clues. There's a friend that I used to work with that always would say, when you need to make a decision on a chart, always look to the left, because the market leaves clues. It doesn't necessarily leave a magnifying glass on how to find those clues. That's where your work comes into play. Or you can work with us and we can help decrease that overall work for you. But always look left. So it's a quick and dirty overview of charts that we wanted to try to give you. We call it Chart 101. And we're very enthused to help you move forward. So with that, class will be exiting, and we will see you next time. Take care.